Most wealth advisors tell you to buy a home because it builds equity, but they ignore a silent tax that drains your net worth every single year. This maintenance cost acts as a continuous leak in your financial foundation, often preventing young professionals from ever reaching the full growth potential of renting and investing the difference instead. Today, we expose this hidden burden known as the maintenance tax, revealing how it silently erodes wealth over decades while you believe you are building an empire. The standard advice to buy a home relies on a narrow view that focuses almost exclusively on mortgage principal paydowns and property appreciation. This perspective treats housing as a savings account where every payment adds directly to your net worth. However, this ignores the operational reality of owning physical real estate. Unlike financial assets in an index fund or a brokerage account, a house is not passive. It requires constant capital injection just to maintain its value and function. The data suggests that for many homeowners, these recurring costs create a drag on total portfolio returns that standard wealth advisors often treat as a one-time entry cost rather than a continuous wealth leak. Let us look at the numbers behind this maintenance tax. Research indicates that maintaining a home typically consumes between 1 to 4% of its value annually. This is not an occasional surprise expense for a broken pipe or a new roof. It is a recurring operational expense, similar to paying rent, but without the option to move if you cannot afford it. When you compound this cost over 20 or 30 years, it creates a significant drag on compounding returns that standard wealth advisors often treat as a one-time entry cost rather than a continuous wealth leak. If your home is worth $500,000, a 2% maintenance rate means $10,000 leaves your pocket every year just to keep the house from falling apart. Quick resource note: I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. The problem deepens when you compare this to renting. In a rental scenario, that same tenant pays rent but does not bear the burden of capital repairs or unexpected infrastructure failures. The landlord absorbs these costs as part of their business model. However, for an individual homeowner, there is no corporate shield against repair bills. You must individually fund what economists call the scarcity premium through higher maintenance and insurance costs. This turns a fixed asset into a high-maintenance liability that competes directly with your ability to save for retirement or invest in other growth vehicles. The gap between the mortgage payment you see on your bank app and the real total cost drains your liquidity, leaving less capital available for wealth-building opportunities elsewhere. This dynamic is particularly damaging when viewed through the lens of tax benefits. Many buyers are told that tax deductions will offset these costs. While it is true that interest payments can be deducted from taxable income in certain circumstances, the reality has shifted dramatically with recent changes to tax law. The IRS caps state and local tax deductions at $10,000. This creates a regressive benefit for homeowners of high-value properties or those living in states with already high property taxes. For medium-priced homes in many regions, this cap means that a 1 to 4% maintenance burden is rarely offset by the savings on your income tax return. The supposed safety net provided by the government often fails to cover even half the cost of ownership for average households. Furthermore, the current economic environment has exacerbated these costs beyond historical norms. Housing costs have surged to 47% of median household income, due primarily to interest rates climbing above 6% and a sharp rise in insurance premiums. This means that for many young professionals entering the market today, the barrier is not just the maintenance tax, but the sheer liquidity required to service the debt on top of those operational expenses. When you add high borrowing costs to the 1 to 4% annual maintenance drain, your monthly cash flow can be consumed entirely by housing before you have a chance to build an investment portfolio outside of real estate. The narrative that homeownership automatically outperforms renting relies heavily on appreciation rates exceeding these combined costs over long periods. However, this assumes a stable market and ignores the supply constraints currently affecting the United States. There is a shortage of approximately 1.5 million housing units. This scarcity forces buyers into bidding wars, inflating entry prices significantly above their intrinsic value or replacement cost. When you buy at an inflated price due to low inventory, your return on investment starts from a much steeper hill than it would in a balanced market. The immediate ROI of the rent versus buy arbitrage is reduced because you are paying a premium for scarcity that may not be recovered through future appreciation if supply eventually catches up with demand. Consider the compounding effect of this missed opportunity cost over time. If you were to take the money spent on maintenance, insurance hikes, and inflated interest payments, and instead invest it in a diversified portfolio earning an average annual return, the difference becomes starkly clear after 2 decades. The homeowner is not just paying for repairs, they are effectively subsidizing their own lack of diversification. They are holding all their wealth in one illiquid asset class that requires constant funding to preserve its value, while missing out on the power of compound interest working elsewhere. This structural disadvantage means that even if house prices rise nominally, your net worth growth may lag significantly behind a strategy of renting and investing the difference consistently over time. The maintenance tax is real, but it is likely secondary to the impact of high borrowing costs and supply constraints in determining whether homeownership currently outperforms renting for young professionals. The silence around this cost allows many families to enter into mortgages they cannot truly afford once all variables are accounted for. They see a down payment as an investment when it may actually be a trap that locks them into a lifestyle of reduced flexibility and lower long-term wealth accumulation compared to alternative strategies. Understanding these mechanics does not mean you should never buy a home, but it requires you must calculate what your money could do if freed from the maintenance tax and locked in a liquid asset instead. The choice between renting and buying is no longer about morality or stability. It is purely a mathematical calculation of net worth growth under current economic conditions. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.